Yes, morning.
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 Now we are starting in a short while. Sorry for the small delay. You can see you guys are joining. So in a short while, we are starting our class. I think I've invited even my CPA students. There are a few CPA students who have joined. Those who are CPA students, I've asked them to join so that we can go through this concept of valuation models. For purposes of applying the same, in mergers and acquisitions, the same way I told you that once we are done with valuation models, we shall apply that concept in the topic of mergers and acquisitions. Last class, I introduced the subject and I went through valuation of debentures. Remember, that's where I stopped. Valuation of redeemable debentures, irredeemable debentures, and I did mention convertible debentures. If I remember well, I think that's where I stopped. I also talked about these general concepts. I explained what valuation is. I talked about the concept of value, book value, liquidation value, substitution, replacement value, going concern value, and so forth and so on. I also talked about the rationale for valuing assets or business. Why value assets or business? I gave various possible reasons. I think I talked about.
Mwalimu.
Yes.
Kindly let me interrupt. You can please mute all those who have refused to mute because I've also communicated the same in WhatsApp and here. If not, we will be throwing someone out. You see, now it's very early in the morning. We need peace of mind. Kindly mute everyone. And if they cannot mute now, we'll be throwing them out.
I think that is a very, very humble request from Madam. I'm hoping that we can really accept that humble request. So I did mention rationale for valuing of business, valuing of assets. I went further to talk about the theories that form the basis of valuation of financial assets, the fundamental theory, the technical theory, the random walk theory. And then, of course, I went through valuation of debentures. I gave a few examples on how to value corporate bonds. And if I remember, I began with redeemable debentures. If you can recall, this is a formula that we used. If a debenture is redeemable, this is a formula we used. Interest times present value of the annuity factor, NKD% plus redemption value, present value factor, NKD%, redeemable. These are those bonds which are issued over a period which is definite. So we can value a debenture based on discounting expected future cash flows. That's what I did. And we treated interest as an annuity. The assumption here is that the interest every year is the same for a period which is known. So when we discount that, we should be able to find the value. We did that example. I went further to talk about debentures which are irredeemable. I use this formula. If there is no definite maturity period, then we say those bonds are bonds which are irredeemable. And therefore, valuation of irredeemable debenture is based on this formula. I think I apply that formula again. So interest over KD%, where interest is treated as a perpetual annuity. Interest in this case is a perpetual annuity. I did mention about convertible bonds. Valuation of convertible bonds is same as valuation of redeemable bonds, except that we have to replace the redemption value with the convertible value. You can see that formula is the same as the one used to value redeemable debentures, except that now here I'm talking about conversion value. Interest, which is still treated as an annuity of a period which is known. Then at some point in time, the debenture is convertible into ordinary shares, giving rise to what we call a conversion value. And I said that conversion value is conversion ratio times market price for each ordinary share at the time of conversion. So when you're dealing with convertible bonds, then we have to capture what we refer to as a conversion value. Interest is worked out the same way, treated as an annuity, then determine a conversion value. And I say that conversion value is basically the market value of ordinary shares obtained per unit of debenture. If a unit of debenture is worth 1,000, that gives rise to how many shares? Ordinary shares. When you convert the bond into ordinary shares, that unit gives rise to how many ordinary shares? Those number of ordinary shares times the market price for each ordinary share at the time of conversion. So conversion value is basically the market price of ordinary shares obtained at the time of conversion. I've given a small example there. There's a small example there which worked out there. But I've not seen your syllabus emphasizing much more on convertible instruments. But it's good for us to appreciate that. Yeah, so conversion value is basically the value of ordinary shares obtained at the time of conversion. If a debenture has a par value of, say, 100 shillings, a unit of debenture has a par value of 100. Now that par value gives rise to how many ordinary shares? Probably 10 or 5 or 20 ordinary shares. What's the price of each ordinary share at the time of conversion? So if you know how many shares will be acquired and the price of each ordinary share, then if you multiply the number of shares, multiply by the price for each ordinary share, then that should give you the value of those shares at the time of conversion. That value of those shares is what we refer to as conversion value. So valuation of convertible debentures and redeemable debentures is similar, except for redeemable debentures, you discount a maturity value. Redeemable are those ones which will mature at some point in time. But for convertible debentures, no maturity will occur. Those bonds are expected to be converted into equity at some point in time. Once the bonds are convertible into equity, it gives rise to a certain number of shares times the price of each ordinary share at that time of conversion, that gives rise to what we call a conversion value. So you pick the interest as an annuity and then conversion value, and then you discount that. For preference shares, valuation of preference shares is the same as that of debentures. I want to move through it very, very fast, and I move on to equity shares. Yeah, so preference shares, just like ordinary shares, are convertible instrument also. The features of preference shares and the features of debentures are relatively the same. One, they're convertible just like debentures. Two, the preference shareholders earn a fixed return in the form of preference dividend, just like debenture holders earn a fixed return in the form of interest. Preference shareholders earn a fixed return in the form of preference dividend, which is fixed. I think even from your accounting perspective, you guys are aware that preference shareholders' return is fixed. The rate at which they earn dividend multiplied by the par value should give us preference dividend, which is fixed. And because preference dividend is fixed, that return is an annuity. Maxi, what's your I'm in class, eh? Yeah. Since a preference dividend is fixed, it is treated as an annuity cash flow for discounting purposes. Eh? Same way, interest is treated as an annuity cash flow. Preference dividend shall be treated as an annuity cash flow for discounting purposes. We could also be having redeemable preference shares, irredeemable preference shares. Okay, so you can see that the characteristics of debentures and preference shares are relatively similar. And for that reason, valuation of preference shares and valuation of debentures proceeds the same way. You can see what I'm saying here. I'm saying preference shares is valuation of preference shares done the same way debentures are valued in all respects. The current value of a preference share is equal to sum of present value of all expected future cash flows from the share discounted at a given rate of return. And this is what we did with debentures. The current value of a debenture is a sum of the present value of expected future cash flows. Whether it's redeemable, whether it's irredeemable, whether it's convertible, we valued debentures on the basis of discounting the expected future cash flows. Now, which are these future cash flows from a preference share? One is annual preference dividend, which is usually fixed. Annual preference dividend, which is usually fixed. And this is determined based on the coupon rate and par value. In other words, you multiply the coupon rate, multiply by the par value, that should give us preference dividend. The fixed annual dividend is therefore treated as an annuity for discounting purposes. That's fine. That's what I've already said. So DP is coupon rate multiplied by the par value. The other cash flow is maturity value of the shares. Of course, this applies now for those shares which are irredeemable, those shares which are issued over a period that is not defined. So the current value of a redeemable preference share, if you check there, I'm given a formula. The current value of a redeemable preference share is given by this formula here. I'm saying MVP. I'm assuming it's a market value. Assuming it's a market value. Preference dividend times present value of the annuity factor and KP%. So this preference dividend we treat it as annuity. You take the rate of dividend, which is fixed, multiplied by par value. That should give you preference dividend, which is fixed. And if the shares are issued over a period which is definite, then of course that becomes redeemable. So that dividend is an annuity cash flow multiplied by the annuity factor and KP% plus maturity value, redemption value, RD, but I think I should have used RP for preference shares. RD is what we used when we were valuing redeemable debentures. Let me use RP, maturity value of the shares times present value factor and KD%, KP. I'm using KP. The discounting rate, let's be consistent. That is KP%. You can see it's the same thing, just like what we have done under valuation of debentures. No, it's the same thing. I've only replaced interest here with the preference dividend. I've only replaced RP. Previously, we were talking of RD, maturity value of the debentures. This is the maturity value of the preference shares. So once you capture the fixed dividend payment, that's discounted, and check if you know the maturity value, it's also discounted. Just check again. Suppose preference shares are irredeemable. Then here, the shares are issued over a period which is not defined. And for this reason, preference dividend is treated as a perpetual annuity. Just like irredeemable debentures, where interest is treated as a perpetual annuity. When you're discounting a perpetual annuity, you take annuity divided by the discounting rate. That's the formula in time value for money. Annuity times 1/R%. Our perpetual annuity here is DP. So DP times 1/KP%. The current value of a preference share is the total present value of expected future cash flows. The expected future cash flows in this case is the constant annual dividend, constant annual return in the form of dividend, which is enjoyed each year in perpetuity, which dividend in this case becomes a perpetual annuity. So that's what I'm saying. You see DP times 1/KP. For the case of debentures, we were saying interest over KD. So preference shares will be saying DP over KP. You see, it's the same thing. You simply discount the preference dividend. Once you establish the preference dividend, which is fixed, of course, divided by the discounting rate, should give you the value for that security. Now, if the preference shares are convertible, then we go through the same procedure again. You need to capture the fixed dividend each year for a period which is defined. At some point in time in the future, conversion takes place, and this gives rise to what we call the conversion value. For the case of debentures, we said interest times annuity factor, then conversion value times present value factor. Same thing. For the case of preference shares, we now talk about preference dividend, which is fixed, multiplied by the annuity factor for a period which is defined. There is a point in time in the future, the preference shares are convertible into equity shares, giving rise to a conversion value. That conversion value is also discounted. The total present value of those future cash flows is the value of the preference share today. It is the current value. And since I went through debentures, we saw what we did in debentures. I think I should expect you guys to connect this to that quickly. Much of my effort today wanted to be centered to valuation of ordinary shares. Once we understand how to value ordinary shares, then of course we'll be connecting this discussion to the next topic, mergers and acquisitions. Same thing applies to my CPA students who are here. I know this topic is not there in section 5 class. That's why I invited you so that you can recall some of these issues. And then of course, we'll be connecting our discussion to the topic of mergers and acquisition in your CPA course. So my concentration is going to be on equity, valuation of equity shares, or sometimes what we refer to as ordinary shares. Now, unlike valuation of debentures and the preference shares, where we have defined specific models applicable to value redeemable or irredeemable or perpetual instruments, valuation of ordinary shares is done using various models. One of the reasons why valuation of ordinary shares is a bit complicated. Valuation of ordinary shares is a bit complicated for various reasons. One, it's done using various models. And because it's done using various models, we expect those models to provide different results. Secondly, the return payable to ordinary shareholders in the form of ordinary dividend does not remain constant. Ordinary dividend can fluctuate from time to time, unlike debenture interest that may remain fixed, or preference dividend that may remain fixed. Yeah, so you see, we have been saying interest is assumed to remain constant. Preference dividend is assumed to remain constant, but ordinary dividend may not necessarily remain constant. Okay, depending on the company policy adopted. Dividend payable can be the same each year, depending on which dividend policy adopted by the firm. But generally, ordinary dividend may fluctuate from time to time. One of the other reasons why valuation of ordinary shares can be a little bit complicated. Now, we have quite a number of formulas, models which are used to value ordinary shares. You can see here, we have the general model, we have the price earning ratio basis, we have the capitalizations model, earnings capitalization model, we have the dividend growth model, the net asset basis, super profits, the Walters model, the Maracon model, and so forth and so on. Now, one obvious reason is that these models cannot provide the same answer. Yeah. You can value a share of the same company, and these models will definitely yield different results. Now, this is a general model. The first one you can see here is a general valuation model, where the value of a share is determined on the basis of discounting the expected future cash flows. The current value of an ordinary share is the sum of the present value of the expected future cash flows. Which are these future cash flows? One is ordinary dividend, which is payable to the investor, which can remain fixed year to year or may fluctuate from time to time, depending on the policy adopted by the firm. I know you guys have done dividend decisions in the past in the topic of financial management, and I mean, in the course of financial management. One of the units which we have already done, I know, is financial management. And one of the topics captured there is dividend decisions. So when I talk about a dividend policy adopted by the firm, I know that you are conversant with those policies. Constant payout ratio, stable, predictable policy, residual dividend policy, and so forth and so on. That influences how much dividend is payable to the shareholders. So one of the future cash flows we have to worry about is dividend payable to the ordinary shareholders. The other future cash flow is cash realized by the investor if a share is disposed in the open market. If you buy a share now, then of course you'll earn a return every year. At some point in time, you decide to sell your share in the open market. Whatever cash realized from the sale of the share at some point in time in the future becomes another cash flow. So going by the fundamental principle, the current value of a security is the sum of the present value of the expected future cash flows from that security discounted at the given rate of return. Which are these future cash flows? These are the ones which I've already talked about here. So like now you can see the formula here saying current value. Is there really need to make marks on my blackboard? I don't think it's really necessary. Those who are making marks on my blackboard, please spare my blackboard. Let it be as clean as it is. This is not fair. Making marks here is not fair at all. This one we see in first year students, not the final year students. Please, let's avoid what you are doing here. So I'll pick the dividend component times the annuity factor. Of course, I've assumed that this dividend is fixed. I've assumed the dividend is fixed. I've assumed the company adopts a stable, predictable dividend policy where the dividend payable each year remains constant. If that were to be the case, then that dividend component can be treated as an annuity. But one thing at the back of our mind is that as far as ordinary dividend is concerned, it's not mandatory that that dividend will remain fixed each year. Please let that be very, very clear at the back of your mind. In the event that the dividend component varies from year to year, then that dividend should be discounted using the corresponding present value factor. If dividend year 1 is 1 shillings, year 2 is 3 shillings, year 3 is 4 shillings, then of course you need to discount those dividend components separately using their corresponding present value factor. But in a situation where the dividend payable each year is the same, like now what I'm assuming here, of course I've assumed that DT is fixed dividend component, just like assumed interest is a fixed return. Same way, preference dividend is a fixed return. Ordinary dividend may be a fixed return, maybe, not must be, maybe. If the DT is fixed, then of course we can treat it as an annuity. Then look at the market price of the shares, you discount using a discounting rate of KS%, and then find the total present value. There's a small example I've given here. Omondi is considering buying ordinary shares of Unga Limited that are currently selling at the Securities Exchange for 30 shillings, currently. So that means if he buys a share, he will buy that share at 30 shillings. He expects the firm to pay a constant annual dividend of 2.5, constant. So that means the 2.5 is more of an annuity cash flow. So 2.5 year 1, 2.5 year 2, year 3, year 4, and so forth and so on. Omondi expects to hold the shares for 6 years and sell them at an estimated price of 35. His required rate of return is 16%. Required, will you advise Omondi to buy shares of this firm? Explain. Last time when I was introducing this aspect of valuation models, I think I said that one of the reasons why we worry about valuation of securities is for purposes of establishing whether securities are overvalued, undervalued, or correctly priced. And once you establish whether they are overvalued or undervalued, it forms the basis of making appropriate decisions, whether to buy or sell securities at the prevailing market price. For us to be able to advise Omondi, we need to find out whether these shares are overvalued or undervalued by the market. That means we have to compare the intrinsic value of the shares with the current market value. Intrinsic is the fair value of the shares. It is a theoretical value of the shares. Yeah? It is a theoretical or a fair value of the shares. So how then do you compare the intrinsic with the current market value? We should be able to tell whether these shares are overpriced or underpriced by the market forces. Already we know the current market value. If you look at the question, it says, currently selling at 30 shillings each. That's the current market price. So what we need to establish is the current intrinsic value, and then we can compare. So the formula I've given here, I'm saying current intrinsic value is equal to the dividend fixed, which is fixed, times the annuity, market price of the shares at the time, at a future time, discounted. The current dividend component is 2.5. You see the question talks about constant. So the 2.5 is an annuity times annuity factor. He expects to hold the shares for 6 years. This required rate of return is 16%, plus after 6 years, he can sell the shares at 35. That's a future value. 35 times annuity factor, times factor 16%. Then of course, now we move to our tables, present value factor tables. If we move to our present value factor tables, 16 under 6, that's the factor that I have. I don't know whether you have those tables with you, could confirm or confirm using your calculator. Even if you don't have the tables, I think your calculators can do. So 16% under 6, the factor I'm having is 3.6847 from the annuity table. 16% under 6 from the other ordinary table, and the answer is 0.4104. If you multiply, this should give us a current intrinsic value of 23.6. Maybe you could confirm whether this answer is correct. Please confirm if that answer is correct in a minute.
It's correct.
It's correct.
So the answer is correct, huh?
Yes.
Yes.
Okay. Now, how do we compare? This is the intrinsic value, the fair value. This share is currently trading at 30. The question says priced at 30 now. The current market price is 30. The current intrinsic value is 23.6. The market price is higher than the intrinsic value. So what do we conclude? This share is overpriced. Since the market price is higher than the intrinsic value, the share is overpriced by the market. It's overvalued. And where a share is overvalued, then we discourage prospect investors from buying the shares because they are overpriced at that time. They are expensive to buy. Yeah. So since the market price 30 shillings is higher than the intrinsic value, we conclude that this share is currently overpriced. And therefore we can discourage Onyango. Was it Onyango or who was this investor? Omondi. We can advise Omondi not to buy the shares of this company now because they are underpriced. Now, as far as dividend is concerned, I think I've been very, very clear. Ordinary. It may not necessarily remain fixed year because it fluctuates from time to time. Even though I'm saying in this illustration, fixed return of 2.5, what we expect ideally is that dividend can vary from year to year, in which case you cannot discount using the annuity, in which case you'll discount the annual dividend independently using the corresponding factor. So please don't assume that each time ordinary dividend will remain fixed. That applies to interest and that applies to preference dividend. It may apply to ordinary shares, but not every time ordinary dividend will be fixed. What I'm saying, if it varies from year to year, discount that dividend component using the corresponding present value factor. The second model that I want to talk about is the price earning ratio basis. I know from your background of ratio analysis, you guys have done some ratios, have you? In financial statement analysis, are there ratios?
Yes. Yes.
And I know you went through a number of ratios. One of the ratios you talked about is price earning ratio. In which category of ratios? Price earning ratio is classified under which category?
Performance.
Evaluation, ratios. Evaluation, or are they equity ratios? Equity, class of equity ratios? Some people call it evaluation or equity. The class of earning per share, earnings yield, dividend per share, dividend yield, price earning ratio, that category. Book value per share. Hizo ratio mlizipata kweli? Yeah, so price earning ratio is one of these ratios given by the market price per share divided by earning per share. The price earning ratio is market price per share divided by earning per share. And therefore, if you express market price per share in terms of the rest, what it means, therefore, is that market price per share is price earning ratio times earning per share. So market price per share is price earning ratio times earning per share. I've simply expressed market price per share in terms of the rest. Some mathematicians like talking about making market price per share the subject of the formula. If we do, then market price per share should be price earning ratio times earning per share. But one thing that we need to appreciate when we are using this model is that in a situation where you have series of historical earnings of a company over the last 5 years, over the last 10 years, you're given earnings, and therefore you can capture the historical earning per share over the last 5 years or 10 years or whichever period. Then when you're valuing a share of a company using this approach, you need to work out the average. We deal with the average earning per share. Average earning per share. So in a situation where you have historical data of historical earnings, then we use the average. Otherwise, the current earning per share should be used. In the absence of the historical figures, then we go with the most recent earning per share of the company. That's very, very important. You could either use the current earning per share, or you may use an average of the historical earnings. Price earning ratio that is used to value ordinary shares can either be the company's price earning ratio or the industrial average. So depending on what is given, if what you're given is the industrial average price earning ratio, then you can estimate value of a share of a company using the industrial average price earning ratio. Otherwise, you can use the firm's price earning ratio. And these are the points which I think I'm clarifying there. That the earning per share that can be used can either be industrial average price earning ratio or the company's price earning ratio. The firm's price earning ratio applied could either be the most recent. No, there's an error here. There's an error here. Earning per share. I think when I was doing the timing, earning per share. Hapa kuna shida kidogo. The firm's earning per share to be used can either be the most recent earning per share or an average. Hiyo mkipata handout yenu mjaribu correct hiyo error. Earning per share. Walali hiyo mkipata hiyo handout mjaribu mrekebishe hiyo makosa I've developed a running nose. Okay, you'll bear with me. This morning, the firm's earning per share applied in valuation. The firm's earning per share, which is applied which is applied could either be the most recent earning per share or an average of the historical earning per shares. I hope that point is clear. I'm hoping that point is clear.
Yes.
There's a typographical error there. So you could use the company's price earning ratio or the industry average, or the firm's most recent earning per share, or the historical figures, depending on what information is applied. A company's price earning ratio is influenced by various factors. That is okay. Here in my story too. Okay, there's a small example I've given here. Kinyi, a prospective investor. Am I being fair to Luos really? Should have used someone else now. Maybe Kamau. Am I being biased? Talked about Omondi, now I'm using Akinyi. Let's use Mweni now. To be fair. Mweni, a prospective investor, is contemplating buying ordinary shares of Upendo Limited. The firm's historical net earnings generated over the last 5 years are as follows. These are net earnings over the last 5 years. So these are in millions. The year 2015, 2016, 2017, 2018, 2019. The firm's net earnings. The firm has in issue 1 million ordinary shares. The industrial average price earning ratio is 20 times. Industrial, there's a spelling error there. Industrial, Industrial inaandikwa namna hiyo kweli? Kwa nini bado inakataa? Oh yeah, imekubali. The industrial price earning ratio is 20, required current market price of each share. Now you can see what we have. These are historical earnings over the last 5 years. Those have been the earnings of the firm. We want to value a share using the price earning ratio basis. You know, there are two ways to go about this, like what I've done here. You see, I've taken an average of these earnings. When you add all the earnings divided by 5, the average earnings is 1.6 million per annum. Maybe you could confirm. Maybe you could confirm. When you sum up all the earnings and divide by 5, does it give you an average of 1.6 million?
Yes.
Yes.
So if we divide by the number of issued shares,
Yes.
that should give us an average earning per share of how much? The shares in issue are 1 million. 1 million shares. So 1.6 million divided by 1 million shares, earning per share is 1.6. Now, the other possible alternative could have been to work out earning per share in the year 2015. Ngapi hiyo? 1.2 shillings.
1.2.
Earning per share in the year 2016 is 1.4 million divided by 1 million. That's 1.4 shillings.
Yes.
The year 2017, 1.6 shillings, 1.8. So then you divide the earning per shares. Divide by 5, you will still get an earning per share on average of 1.6. So if we go back to our formula, the market price for each share is the price earning ratio times the average earning per share. So price earning ratio, I've given 20 times. 20. Multiply by the average earning per share of 1.6, that is 32. So you are valued a share of this company using the price earning ratio basis. These formulas inakaa ni formulas ziko rahisi tu. Sindio?
Yes.
See, the only tragedy is that if you forget the formulas, then you cannot proceed. The third model, earnings capitalization model, sometimes referred to as capitalization of earnings basis. Capitalization of earnings basis. This evaluation approach used to value shares of a firm under certain conditions. The capitalization of earnings model is used to value shares under certain conditions, where the firm's historical or future earnings have remained relatively equal or rather constant. I don't know whether that really applies in practice, saying earnings over the last 5 years on average have remained constant, or earnings over the next few years are expected to remain relatively constant. This is what I'm saying here. You can see here, earning per share year 1, earning per share year 2 is equal to earning per share year 3 shall equal to earning per share at the time of infinity. Can you see under that condition? Yeah. There are two main conditions under which the capitalization of earnings model is used. One is where earnings are expected to remain constant. Secondly, is where a firm adopts 100% payout ratio as the dividend policy. 100% payout ratio means what? All earnings are shared as dividends, isn't it? If a firm adopts 100% payout, means all earnings which are attributable to the owners are shared as dividends. Zero retention, eh? Does it apply in practice? Huh? That does apply in practice.
No, it doesn't.
I don't think so.
All earnings are shared as dividends at 100% payout. Now, the argument here is that the firm has no justification of retaining earnings if they cannot reinvest those earnings more profitably to give you a higher return in the future. That's the argument behind the adoption of this policy. That because the future earnings or future dividends are expected to remain constant each year, then there is no justification of the firm retaining earnings for investment purposes. You see the logic, eh? Are you seeing the logic behind this argument? That this firm is expected to provide the same return every year in perpetuity. You don't expect a higher return. And therefore, there is no justification of the firm retaining earnings for investment purposes. The argument here, therefore, is that such earnings should be given to you. Such dividends should be given to you so that you can invest on your own to generate a higher return. I think that has the justification. I didn't explain it here in these notes. Eh? I didn't explain that argument there. But you can see that that's basically the logic, that the future earnings, the future dividends are expected to remain constant every year. Therefore, even if a firm were to retain those earnings, they cannot invest the earnings more profitably on your behalf to give you a higher return. So what's the point of them retaining? The argument, there is no justification. And therefore, those earnings should be given out to investors to invest on their own. So if those two conditions are met, then we can value a share of a company using the capitalization of earnings. Now, if earning per share year 1 and equal to earning per share year 2 equal to earning per share year 3, then again, takes us back to perpetual annuity. I hope you are seeing here again. Earning per share year 1 is equal to earning per share year 2 shall equal to earning per share, and this shall equal earning per share infinity. So the earning per share is a perpetual annuity. I'm hoping you are seeing this.
Yes.
And therefore, I'm discounting earning per share as a perpetual annuity. Annuity times 1 over R%. So if earning per share is a perpetual annuity, and the discounting rate is KX, so it is EPS times 1 over the discounting rate. So the price of a share is earning per share divided by the discounting rate. But because the firm adopts 100% payout, then it means that earning per share is equal to dividend per share. At 100% payout,
Elias, check Chege can please mute his mic.
Watu wengine wanataka kusumbua watu tu bure, si ndio? Watu wengine wanafurahia tu kusumbua wengine.
Wamezoea hivyo.
Haya, sawa tu, waje tuvumilie tu. Sababu tukianza ukazirika saa hii, siku yetu itakuwa refu na sio mzuri. Mimi sasa uanza ukazirika saa hii, siku yangu iharibike bure. So, at 100% payout, dividend per share is equal to earning per share. You see how the formula becomes? You can discount the earning per share or discount the dividend per share. But the most common formula that we normally come across in most of the books that you are reading, in most books, you might find them talking about D naught. I think for those of us who love reading widely, you might find them talking about D naught, the D naught over KS. Kwa wale wenzangu wanapenda kusoma widely, I think you might find that kind of a formula. D naught divided by KS percent, where D naught represents D naught divided by KS percent. You are likely to find most books giving that formula. D naught divided by KS percent, where D naught is the fixed dividend component. I don't know whether you've come across such formula before. Have you?
No.
Even in the topic of capital structure in financial management, when you are getting the cost of equity, you didn't say KS is D naught over P naught.
Yeah.
The cost of equity in a situation where dividends are not growing, cost of equity is D naught over P naught. Just rearrange. You know, this KS is the minimum required rate of return, which is basically the cost of equity to the company. It's a return to the investor, but it's a cost. It's a cost from the company's perspective. Okay. I have given a small example here. Management of Mashariki Limited expects the firm to generate a constant annual earnings of 30 million at the end of each year in perpetuity. The firm currently adopts 100% payout as it is dividend policy, and as in issue 5 million shares. The investor's minimum required rate of return is 10%. Can you see? It confirms straight away which model is appropriate. If you see the framing of the question, constant annual earnings. Firm adopts 100% payout. Now, you see, we don't have to tell you which model to use in that case. Straight away. From the details given, you can see that valuation should be based on the capitalization of earnings, current intrinsic value of a share. Suppose each share of this company currently sells at 20 shillings each. Is a share overvalued or undervalued by the market forces? So in the light of the information given, the current intrinsic value should be worked out using the capitalization of earnings. Now, I've begun by working out the value of the firm. Current value of the firm, net earnings divided by the discounting rate. The net earnings are 30 million divided by discounting rate, 10%? Yes. So 30 million divided by 10%, should that be 300 million?
300 million, yes.
The current value of the firm. How many shares are in issue? 5 million shares. The question talked about 5 million shares. So if you take 300 million divided by 5 million shares, what is the current value of each share? It need to be 60 shillings.
Yes, it's 60.
Now, could it have been different if you worked out average earning per share? If you take that million divided by 5 million, what's the average earning per share? The net earnings divided by the number of shares in issue. The average earning per share, 6 shillings.
Yes.
And now that the dividend payout ratio is 100%, that means dividend per share is also 6 shillings.
Yes.
Earning per share is equal to dividend per share, which is 6. So if you take the dividend per share, 6 divided by 10%, does it still bring you at 60 shillings?
Yes.
Now,
Yes.
I'm showing an alternative way. What I've worked out here, I've used value of the firm, which is 300 million, divided by the number of shares. But what I'm saying, you could opt to work out earning per share and determine dividend per share, and then discount the dividend per share to get the value of a share. I didn't work out the alternative, but I'm sure you can see it from afar. Senior. I'm hoping that you can see that from far. Okay, suppose each owner shares of the company is currently selling at the intrinsic is 60. Suppose that you were 50. 20 is too low. It's too low. I'm not saying that. Let's work with 50. Suppose the shares of this company are currently selling at 50 each. Is the share overvalued or undervalued by the market forces? Now, the intrinsic value is 60. Market value, 50. Do you think the share is overvalued or undervalued?
It's undervalued.
Yeah, I think I should have made that comment. I didn't make, but you can see, you can make a comment on your own. The share is currently undervalued. Undervalued by the market forces. By the market forces. This is because the current market price. This is because the current market price is lower. It's lower than it is intrinsic value. The intrinsic value is 60, the market value is 50. So it looks like the share is currently underpriced by the market forces. That comment, I didn't put it in the document I've already shared. I shared with you this document, isn't it?
Yes, the notes are in the module.
Yes, yes.
And there's some of these issues I'm observing, you can see there was an oversight when I'm doing. Okay, let me move to the other very, very important model, the dividend growth model. I think this has been one of the popular approaches of valuing shares. The dividend growth model, or the Gordon's model for dividend growth, is usually known as the dividend growth model or the Gordon's model. It's a model by, I think, a scholar known as Gordon. You have heard of Gordon? Is it Gordon or Goridon? Hiyo jina inakuwa pronounced namna gani? Gordon or Goridon?
Gordon.
Gordon. Gordon could be the name of a guy who came up with this model. The Gordon's model. Just like you can come up with a model in the future and you name it after you. Say your Mondi growth model, or a Kamau growth model. And then people will study the model all over the world. Gordon. What I'm wondering is that we are professors in Kenya. Why have we not heard of a model by a professor from Kenya? Is there professors in Kenya? In various fields. We heard of a model by a professor.
Woman's model.
Huh? Model, is there a professor who has come up with a model in finance? Develop your model, you test, and the people learn that model. Which one? Which one?
None.
They are still working on them.
Yeah, it's not easy. You come up, develop a model. Now, what was all over the world is acceptable. Yeah, you have to convince. You never research. When you're doing modeling in research, you apply the existing models. Research methodology. You model based on the existing models. So there's a Gordon's model, which is applied to value ordinary shares under one main condition. The firm's future dividends should grow at the same rate each year in perpetuity. Now, this one we have gone through here. No growth. So the capitalization of earnings model, you see there was no growth. But when we bring in the issue of dividend growth, if future dividends are expected to grow at the same rate each year, then we use the dividend growth model. I tried deriving this model here. See, I was saying dividend payable in a year's time from now is D0 1 plus G. Dividend payable in 2 years' time is D0 1 plus G raised to the power of 2. Dividend payable in 3 years' time, and this goes on up to infinity. I think here I should have said infinity, not N. I should have said up to infinity. This continues up to infinity. Yeah? Even here, this power, I should have said infinity. Yeah? It goes on up to infinity. Yeah? That goes on up to infinity. Yeah? I don't know why it's refusing to work. That power, I wanted to raise it to the power. Okay, so it goes on up to infinity. Up to infinity.
Yes.
So the growth rate is the same each year, and this goes on up to infinity. So the current price of a share is sum of the present value of the expected future cash flows. You can see dividend in a year's time, D naught 1 plus G raised to the power of 1, discounted. Dividend in 2 years' time, discounted. Dividend in 3 years' time, discounted. And this goes on up to infinity. Yeah? So the sum to infinity is this. I think yeah, that's the sum to infinity. Of course, if we pull out a common factor, those of us who are in our class, I'm sure, I derived this model there. So the business finance or where? Yeah, business finance class. Okay, let's avoid so many stories. This is the model which we have here. What's important is the model. I don't think we shall ask you to derive the model, but it's good to know how it comes. What is important is the model. The one you are seeing in red is the dividend growth model. D naught is the current dividend. G is the constant annual dividend growth rate. D naught 1 plus G is D1. Dividend payable in a year's time. KS percent, G percent. Yeah, so that's the model that is used to value a share. P naught is the price of a share. When you check, I've given a small example here, which I want us to go through very fast. ABC Limited's historical earnings and dividend over the past 5 years are as follows. The year 2015 up to 2019. Comparative data, earning per share and dividend per share. Just check. What are you observing on the pattern of the data?
Growth. DPS.
All of them are growing. Earning per share is growing. Dividend per share seem to be growing. Just respect from the year 2015 up to the year 2019. Yeah, clearly you can see that the earning per share are going up, and clearly we can see that the dividend per share are increasing. When you sense that, then this model is appropriate to value a share in a situation where the earnings and dividends seem to be growing. The investor's minimum required rate of return is 19%. Required historical annual dividend growth rate, current intrinsic value of each share. Historical annual dividend, not earnings. Annual dividend growth rate. Now there's a formula which we usually use. I know you guys are familiar with this formula. The growth rate.
Yes.
Dividends, I'm sure you would be familiar with that formula. The formula I'm talking about is this formula. We say growth rate is nth root of latest dividend per share. Latest dividend per share over the earliest dividend per share minus 1. All of these times 100. That's the formula I'm talking about. The most recent earning per share divided by the earliest, take the nth root minus 1. Look at the historical data, you can see the most recent dividend is how much? The year 2019.
2.
2. The earliest dividend, the year 2015 was how much?
1.
1.
1.2.
1.2.
1.2.
And what's the value of N?
4.
That dividend was paid over many years?
4 years.
2015, 2016, 2017, 2018, 2019. Is it 4 or 5 years?
5.
5 minus 1.
Yeah, you remove 1. You know, you look at the growth here, 2015, 2016. That's the first time dividend went up. The second time, dividend went up. The third time, and the fourth time. So you don't take the number of years here. Eh? You should be careful. Eh? Dividend has been paid over a period of 5 years, but I'm taking the fourth root. Eh? You don't take the fifth root here. Yeah, N is the number of times dividend has grown, not number of times dividend has been paid. So if dividend has been paid for 6 years, N should be 5. If dividend has been paid for 10 years, N should be 9. Eh? Yeah, so the fourth root of that minus 1. And check where I put my 1. Kokando sana, eh? The common mistake people make is this. Eh? You see the common mistake? Eh? Tafadhali wacha tutumie zile formula ziko. Eh? Some of us have come up with our own formulas. EO is acceptable maybe at the very, very high level of academia. Lakini sahi, you could come with a formula at a high level. Lakini hii wacha tutumie zile ziko. Eh? Tafadhali, eh? Wacha tuwache kutumia formula zetu. Eh? So the answer I got is how much?
14%.
18. The historical dividend growth rate, eh? 18.
14.
14. Okay.
Yeah.
Now, in some cases, you may work out growth rate using another formula. There is return on equity times retention ratio. Eh? I'm not sure whether I clarify this in the handout. The Gordon's growth approximation equation. G is RB. E inaitwa Gordon's growth approximation equation.
Mwalimu, is it 13% or 14?
Eh? Hata sikumbuki, ndio nimetoka kwa handout.
It's
Am I getting
14.
13? Am I getting
Get
13.6?
it 13.62.
13.6, Mwalimu.
Hiyo ni 14 tu. 13.6 round out. You can round out, eh? 13.6. If you round off to 14, I think that is not a big, sio mbaya hiyo. Hiyo is acceptable, eh? It's acceptable. Now, sometimes you can, now this formula is only used when you have historical data, like the ones we have. But in the absence of the historical data, then you need to, can use the Gordon's growth approximation equation. Eh? G is return on equity times retention ratio. This is known as the Gordon's growth approximation equation. Eh? The use of the Gordon's growth approximation equation. Eh? How do you arrive at return on equity from your ratio analysis? What is the formula for finding return on equity?
Net income over equity.
Net income over equity capital. Eh?
Yes.
Multiply by 100. So your background of ratio analysis, I think, helps. How about retention ratio?
It's 1
1 minus
one minus
payout ratio.
payout ratio.
Dividend payout. How do you arrive at dividend payout ratio? The retention ratio is 1 minus dividend payout. Now, how do you get the dividend payout? What is the formula for finding the dividend payout? You may take dividend per share of earning per share times 100. Eh? Or total dividends over the total net income. Eh? The total dividends over the total net income times 100. Eh? I should give you the dividend payout. So in a situation where we have no historical data and you sense that information exists, then you can again work out the growth rate using the Gordon's growth approximation equation. It is important that you observe what information you have, whether the growth rate can be captured using the Gordon's growth approximation model, or you can use the other general formula. So we have worked out number one, the historical annual current value of each share. So this one we bring in out the formula. This one, P naught is D naught 1 plus G divided by KS minus G. Remember, KS should be in percent. KS percent. That G percent, so that we don't make a mistake. Yeah. If it is 10% minus 5%, that is 5%, 0.05. So in the historical data, which is the most recent dividend, you see, you pick from the historical data. D naught is the most recent dividend is 2 shillings. This one here. This is the historical dividend. So you pick the current dividend 2, which is expected to grow at 14%, divided by discounting rate is 19% minus 14. Is the answer correct? Is that answer correct? If you take 2 times 1.14 divided by 0.05, is the answer 45.6?
Yes.
Now, do we know the current? Now we have answer number 2, current intrinsic value. Suppose the current market price of each share is 40. Could you advise a prospective investor to buy the shares of this firm, and why? Suppose the current market price is 40. Will you advise a prospective investor to buy the shares?
Yes.
Yes, you will, because the share is underpriced. This is the intrinsic value. The share is undervalued by the market. Market value is lower than the intrinsic value. This share is undervalued, and therefore we can advise a prospective investor to buy the shares. Number 4, suppose the firm's future dividends were to grow at the rate of 10% each year for the next 3 years, 16% per annum for the next 2 years, and thereafter revert to the historical growth rate and remain constant each year in perpetuity. Will this alter decision made in part 3 above? Include suitable calculations. Now, if you look at, we are being asked the same question we have answered in number 2 and 3. Except now, when answering number 2 and 3, we have used historical data. Are you seeing? We have used historical data or dividend payments in working out the current value of a share and advising number 3. We have worked out the current intrinsic value using historical data. Now, in part 4, we are again expected to work out the current intrinsic value, but using future data. So I think that should be very, very, very clear now. We have used historical data so far. Number 4, I've framed it in a manner that now we have to use the future data to be able to find the current intrinsic value. Otherwise, I'm answering the same questions we have answered in number 2 and 3, except that in this case, we will be using future data. That's why we are being informed here that dividends can grow at 10% for the next 3 years, 16% for another 2 years, and then remain constant in perpetuity. So we need to start by establishing the future dividend. This is the one I'm working out here. I think there's an error here. We made an error. I think I made an error. I've definitely made an error. Fanya hii error zote nilikuwa naangalia wapi. This should be year 1. This should be year 2. This should be year 3. This should be year 4, eh? And this should be year 5. It should be year 5. And therefore, this should be year 5 up to infinity. Yeah? I'd made some small, year 6 up to infinity. Yeah? There was an error there, which I have corrected. You can see there was a small issue with my alignment there. So we need to find the future values. I expected dividend year 1, time from now, year 2, year 3, and so forth and so on. Now, which is the most recent dividend in the historical data?
2.
2 shillings. So what dividend is payable in 1 year's time from now? If these dividends were to grow at 10% for the next 3 years, so 1.1 is a power of 1, is that 2.2? Dividend payable in a year's time from now? Is that 2.2?
Yes, it's 2.2.
How about 2 years time from now? The rate is 10% per annum for the next 3 years. The first 3 years, the same rate. So you can even say 2.2 times 1.1 or 1.1 squared. It's the same thing. Eh? Does it give you 2.42? 1.1 squared. It's 2.42.
Yes.
Suppose you
Yes.
take 2.42 times 1.1 without squaring. 2.42 times 1.1. Does it give you the same thing?
Yes.
You can
Yes.
decide to compound from the initial 2 or simply take 2.2, take a 1 year growth. That's a 1 year growth. Like now here again, I could have said, if you take 2.42 times 1.1, will give you the same answer. Or I pick it from the initial 2. It's the same thing. Eh? If you take 2.42
Yes.
times 1.1, what is the answer? 2.662.
Yes.
1 year
Yes.
growth. Eh? Or I can choose to compound from the initial. Eh? I hope you can see what's happening there. When you come to year 4, now the growth rate, year 4 and 5 is 16%. Eh? Suppose you take 2.662 times 1.16, I think you'll get the answer straight away. Eh? 2.662 times 1 plus 16%. If you pick it from here and subject it to a growth of 16%, 2.662 in bracket 1 plus 16%, eh? Does it still give you the same thing? Year 4, year 5, the growth is 16. 2.662, let it grow by 16.
3.08.
08 or 09?
0879.
Are you saying this answer is wrong?
Yes.
3.09.
Okay. Now, year 5, the same growth rate. So this one I should change. If it is wrong, I can change.
Just remove the 2.
But is year 4 and year 5 the same thing? Or year 5 they wrong?
Year 5.
Okay, so 3.09.
Malim, is it 2.662 times 1.16?
1.16, yeah.
Year 4 is wrong, Malim.
Malim is wrong. 3.08.
What is the answer here?
It's
For year 4,
3.09.
08.
oh. For year 4, the answer is 2.92.
No.
No, it is 0.09.
What you are saying? You're simply saying 2.662 times 1.16. 3.087.
So this
792.
3.087.
So
3.09.
that is 09, yes.
Na ukikuja hapa,
It's the same.
no. It can never be the same.
No. 3.5.
3.58.
This one, it's raised the power of 2 here.
Mhm.
It is raised the power of 2. What is the answer?
3.58.
0.58, yeah. There's an error here. Now, I'm using my compounding approach, which is a little complex. But you know, you can only take 1 year growth, 3.09 multiplied by 1.16 straight away. I'm using my compounding models. But you know, if you take 3.09, increase it by 16%, does it give you 3.58?
Yes.
Yes.
That means the error is carried forward here. I'll come here and say 3.58. Kulikuwa na error hapo. So we need to compute this price. Definitely, then there's an error. 3.58 times 1.14 divided by 0.05. That price is 81.67. Is that so?
81.624.
0.67. 0.7. 0.34.
24.
624.
Mimi yangu ile nimepata ni 81.67.
81.6.
1.624.
0.7.
624.
624.
Inatoka 24 inatoka wapi? It is 3.58 times 1.14 divided by 0.05.
81.624.
624.
624.
Yeah. 24.
Yes.
Yes.
3.58 times 1.14
Divide by 0.05.
and 0.5. 81.62.
Oh,
Yes.
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 Now, look at the question. Okay, let me correct this first. Then we can continue. Times 0.4190 is 34.2. 34.2. Hii yote ikiongezwa, it affects this. Plus 1.295 plus 1.54 plus 1.58 plus 1.71 plus 1.85, 42.2. Total present value is 42.2, eh?
Excuse me, teacher.
Yes.
On year 5, the present value will also change.
5. Oh,
We've already changed.
No,
I changed. Okay.
you haven't.
3.5.
It's 1.5.
times 0.4190. 1.5, eh?
Yes.
Yeah, ideally that should change also because the figure changed. So what's the total? Anybody who has got it? $42.4. Is the answer roughly 42.4?
Yes.
Yes.
42.4.
Okay, now when you look at year 6 up to infinity, you need to be a bit careful. Eh? Because the question told you 16% per annum for the next 2 years, and thereafter revert to the historical growth rate. What was the historical growth rate? 14%.
14.6. Yes, 14.6.
Historical 14.6. We revert to the historical rate and remain constant in perpetuity. Now, when we bring in this aspect of growth rate occurring in perpetuity, then we bring in the dividend growth model. Eh? You see, I've introduced my dividend growth model. That's one of the conditions in which the dividend growth model is applied. It's applied to value equity shares in a situation where dividends are expected to grow at the same rate each year in perpetuity. Eh? And now that that is the situation we have found ourselves in, year 6 up to infinity, then we value a share using the dividend growth model. The most recent dividend is 3.58, which will grow at 14%, divided by 19 minus 14%. Eh? So we value a share. We value a share at the start of year 6 or end of year 5. Eh? In this case, we work out the value of a share at the beginning of year 6 or end of year 5. Eh? It's important that you find out that the P note you are establishing will be P note start of year 6 or end of year 5. So if one were to buy this share, you'll get a return of 2.2, 2.42, 2.662, and so forth and so on. Then at the beginning of year 6 or end of year 5, can sell a share at it 1.62. So in this case, if you discount this, you should be very careful with the discounting factor. You can see the discounting factor I've used in discounting 3.58, 81.62 is the same. Eh? You realize the other common mistake people make, they'll go to year 6 here. 81.62 is not price end of year 6. It is price beginning of year 6. 81.62 is price beginning of year 6. Eh? Or end of year 5. And that's why I'm using a present value factor, end of year 5. So when you discount this, you can see the price is 42.4. Intrinsic. What was the current market price? The current intrinsic value is 42.4. Market price is what? What was the current market price of the share?
40.
40.
81.62.
40. Is the share overvalued or undervalued by the market? Intrinsic is 42, market price is 40. It's under price. So this changes decision we took earlier. The market price is 40, intrinsic value is 42.4. Since the intrinsic value of the share is higher, the intrinsic value of a share is higher. The current market value, the share is underpriced. Oh, it's okay. The market value, was it 40? Was the market price 40?
Yes. 40. Overpriced.
Intrinsic, so it's overvalued, eh? It's undervalued. It's okay, it's undervalued. Market price is 40, intrinsic. The share is still undervalued, eh? So it does not change the decision. The share is still undervalued by the market forces, eh? That's the same conclusion we arrived at here. So it does not change. It does not change the decision we made up there. In this case, prospective investor will be advised to buy the shares of the company. Yes, this will alter. No, it does not. Eh? What decision did we make earlier? Number 3.
Buy. Decision was to buy.
The investor to buy.
So it has not changed. Decision has not changed. Eh? Why am I saying yes? No.
Because you have used that 7.
So here we can say no. Yeah, we'll use the previous one. Eh? This will not alter. This will not. So you need to change in the document that you have. Eh? This will not. Decision in 3 above. Did we discourage in 3 above? Or we encourage? I think I was explaining my own things, but you can see what's happening. Eh? Will not alter the decision made in part 3 above. In part 3 above, we advised prospective investors to buy. In part 4, the decision has not changed. Okay, so I think that is about that model, the discount, the dividend growth model. Now, let me mention the other models quickly so that we can wind up this discussion. There is a Walters model, or the discounted free cash flow basis. Now, I think for purposes of the topic mergers and acquisition, there's a model which we are going to talk about known as discounted free cash flow basis. Eh? When you value a company, maybe it's a target firm, you want to know the value of a target firm for purposes of mergers or acquisition. We are going to see in the next topic. But one of the reasons why you value a company or value a share of a firm is for purposes of mergers or acquisitions. And one of the popular models used to value a target firm for purposes of mergers or for purposes of acquisition is referred to as a discounted free cash flow basis. Eh? Discounted free cash flow basis is a popular model that is used to value companies to establish the going concern value of the firm. If you were to acquire an existing firm on a going concern basis, then you may wish to establish the current value of that firm on a going concern basis. And therefore, discounted free cash flow basis is one of the popular models used in establishing the current going concern value of the firm. And therefore, that is the basis upon which to establish the maximum price payable to acquire the company on a going concern basis. That maximum price payable to acquire the firm on a going concern basis is the equivalent of the current value of the firm. That current value of the firm is more often determined using quite a number of models, but one of the popular models is known as a discounted free cash flow basis. What are these free cash flows? Free cash flows are the remainder of the earnings of a company after meeting all commitments. And that's why I'm talking about free. It is the uncommitted cash flow. It is the remainder of the cash flows after meeting all commitments. So from your sales revenue, you remove cost of sales, you find your gross profit. From the gross profit, you remove operating expenses, you remove selling and distribution expenses, you'll find profit before. Operating profit, you remove any financing expenses like interest, you'll find profit before tax, then less corporation tax, you'll find profit after tax. After you have established profit after tax, retain enough. If you have projects to undertake, then you need perhaps to finance some of those projects from your internal sources. If that is what you want to do, then you retain enough of the earnings to finance the projects. The remainder of the earned cash flows after meeting all commitments, including financing the firm's optimal capital budget, including financing all investments which are acceptable, is what we call free cash flows. Now, using the fundamental principle, the current value of a firm is the sum of the present value of the expected future free cash flows. The current going concern value of the firm is the sum of the present value of the expected future free cash flows discounted at a given rate of return. Many times, if you are valuing a company, the overall firm, then the weighted average cost of capital is used as a discounting rate. If you are valuing a share, cost of equity is applied as a discounting rate. This is a point I'm trying to say here. The current value of the firm. This is free cash flow year 1 discounted, free cash flow year 2 discounted, free cash flow year 3 discounted, and so forth and so on. I think I should have said here that C1, comma, C2, all that up to Cn are free cash flows, are the free cash flows. Free cash flows year 1, year 2, all the way up to time n. Those are free cash flows. So going concern value is an approach where the current value of a firm is captured on the basis of discounting the future free cash flows using many times firms' weighted average cost of capital as a discounting rate. What I know is that you guys are in a position to work out weighted average cost of capital. I don't think really there should be an issue with the computation of the weighted average cost of capital. We expect that from your other subjects, from business, finance, financial management, should be comfortable in establishing the weighted average cost of capital. When I move on to the topic of mergers and acquisition, I'm going to apply that approach in some of the illustrations which I'll be going through. I've explained what free cash flows are. Once you've established the free cash flows, the rest is discounting. The Walters model is another approach used to value ordinary shares. This is a model by a scholar known as Professor James Walter. Professor James Walter. I don't know whether you found this scholar in dividends. Did you come across the Walters model in dividends?
Yes.
Financial management?
Yes.
I think Professor James Walter is the same James again. In dividend, there is the Walters dividend model, dividend theory, which is basically a theory by, again, the same professor, where the current value of a share is worked out using this model. The price of a share is equal to DPS, dividend per share, R% divided by KS, in bracket EPS minus DPS divided by KS%, where P0 is the current price of a share, R% is the return on equity, KS is cost of equity. I believe it should be clear what distinction exists between the return on equity and the cost of equity. Cost of equity is the minimum required rate of return. Return on equity is the actual return. Earning per share and dividend per share. Okay? Yeah, so once you capture the dividend per share, return on equity, and the cost of equity, we should be able to use this. Now this one, I have not done any illustration on discounted free cash flow basis because I know in the next topic, dividend policy, I'm going to bring an illustration on that. And I'll show you how to apply this model to value companies for purposes of acquisition or mergers. Merging or acquisition results. I've given a small example here on the Walters model. Happy Textile Limited adopts 60% payout ratio as its dividend policy. The firm generates 10 million profit after tax in each year. The firm has in issue 2 million shares. The net worth of the firm are, net worth is equity, 50 million. When you talk about net worth, ideally is equity, ordinary share capital and reserves. Yeah, net worth is a function of equity. It's ordinary share capital and reserves. The investor's minimum required rate of return is 10%. Current intrinsic value of each share using the Walters model. So the formula I've already given you. What you need to look for is earning per share. The formula for earning per share, net earnings over the issue number of shares. You can see from the question, the net earnings are 10, number of shares 2. So obviously earning per share should be 5. Yeah, so once you have got earning per share, the firm adopts 60% payout. Therefore, dividend per share is 60% of the earning per share. That should be 3 shillings. Payout is the proportion of earnings shared as dividends. Then we need to look for return on equity. Net earnings over equity times 100. Net earnings, in this case, 10 million. Equity, 50 million, the net worth. So return on equity is 10 divided by 50 times 100. That is 20% return on equity. So if we go back to our formula, dividend per share is 3, return on equity 20% divided by 10%. Earning per share is 5 minus 3 divided by 10%. Please take note here is that you must take 20% divided by 10%, that is 2, multiplied by the difference between 5 and 3. 5 minus 3, that is 2. 2 multiplied by 2, that is 4 plus 3, that is 7 divided by 0.1. The value of a share should be 70. I think that should be 70. Unless you confirm otherwise. Is the value of a share 70 using the Walters model? So you need to be careful with the BODMAS rule. The other formula, the other approach is net asset basis. Is this confirmed?
Yes.
Okay, net asset basis, where a value of an ordinary share is worked out using book values. When you went through ratio analysis, you talked about book value per share under the class of equity ratios. So net asset basis is an approach where value of each ordinary share is worked out using book values. So the value of a share that we are determining is known as a book value per share. Value of a share worked out using book values. This is the one I'm talking about here, PVPS, book value per share. You take the value of all the assets. So this one is an asset-based approach. I think I've clarified that, have I? Yeah, this is an asset-based approach where value of each owner share is captured using book values. That is determining the book value per share. If a firm were to be, those are stories now, of course, but let's not go into those stories, this is on the summer. So book value per share, non-current assets plus current assets, less current liabilities. FA represents fixed assets or the non-current assets, but of course at their net book value, because those assets depreciate. So when you go to your statement of financial position, pick the value of non-current assets at their net book value, plus current assets, deduct current liabilities, deduct long-term liabilities, deduct preference share capital, divided by the number of issued ordinary shares. And by the way, if you check the numerator here, once you deduct all that, what you're left with is equity. If you look at how a statement of financial position looks like, just imagine how it looks like, a statement of financial position, what sometimes you simply call a balance sheet. If you take all assets, deduct all liabilities, deduct preference share capital, what you're left with is equity. So in other words, the book value per share is equity divided by the number of shares in issue. And I know from your background of business finance, you guys are aware that equity is owners applied funds. Reserves are owners applied long-term capital, be they revenue or capital reserves. And these are the kind of stories I was giving there. That book value per share reflects approximately how much the shareholders have financed the company. It's a reflection of the extent to which the owners have financed the company. Okay, so as simple as that, I've given a small example here. Following is a statement of financial position of this company on 31st December 2019. What I've given you is a statement of financial position, summarized statement of financial position of this company. Non-current assets, we have current assets, total financed by ordinary share capital, retained profit, share premium, equity, 10% venture capital, 12% preference share capital, current liabilities, we have creditors, accrued expenses, and the total is this. Debit and the credit side of the statement of financial position are in agreement. Required using the net asset basis, compute the current value of each ordinary share. Oh, hiyo ni kama sijaifanya, lakini hiyo zinakaa ni kitu rahisi. Unaona sijaifanya hiyo swali mimi. Is it possible for you to work out the value of a share, book value of a share, using the formula I've given up there?
Yes.
Yes.
You mind please working it out for me? Confirm the answer. Sijaifanya? Sasa tunaomba mtufanyie na nyinyi. The formula is here. Formula ndio hiyo. This is the balance sheet. We have said all assets less current liability less long-term less preference share capital divided by the number of shares in issue. Balance sheet ndio hiyo. Can you please work out the value of a share using the net asset basis? Hiyo ni dakika tatu tu. Hata dakika moja. Anybody else got it? Yeah, I think that's correct. The book value per share is 30 shillings, eh? Kila mtu amepata hiyo? Should be 30, eh? Are we in agreement?
Yes.
Now, the other model, hizo model zimekuwa mingi. Mpaka nasikia zimenichokesha sasa. We have the Marcon model. Using this approach, the current value for each share is determined as follows. You guys went through the market value, book value ratio, eh? In ratio analysis, again, Marcon developed this model from that background, eh? Comparing the market value of a share and book value per share, working out what we call the market value to book value ratio. Market price of a share divided by book value per share is equal to R minus G over KS minus G. So if you express MPS is equal to book value per share R minus G over KS minus G. This is a Marcon model, eh? If you make this a subject of the formula, so ideally, MPS over BVPS is a ratio of market value per share to book value per share. So if you make the market value per share the subject, should give you book value per share. Just a minute. Nitumia namba yake sasa ya simu, mimi sielewi namba yake ya registration. Okay, so like now we have already worked out book value per share. Like the one you have got 30. So if you knew return on equity maybe 20%, growth rate maybe 10%, maybe 5%, cost of equity maybe 10%. So it starts with capturing the book value per share, like the one you worked out, you found 30. So given the return on equity, given the growth rate and the cost of equity, you can then substitute and work out the market price of a share. So the approach involves establishing the market price of a share in that manner. Once you have established the book value per share, given the return on equity, the cost of equity, you should be able to arrive at that. You see the same example we have here? This is the formula. So you express MPS in terms of the rest. That's what we have talked about. Did I copy paste the same illustration here or not? Same illustration. Looks like the same illustration, eh? Or did I supply additional information? Following the statement of financial position of XYZ Limited. Oh, I've supplied additional information, eh? This balance sheet we have here is the one we had here, up here. Additional information, firm generates annual net income of 25 million on average, adopts 40% payout as its dividend policy, minimum required rate of return by investors 10%. Using the Marathon model, calculate the current value of each ordinary share. I think we already know the book value per share. You have noticed I've used the same illustration up there, except that I have supplied additional information. E to E, the one you have used in establishing the book value per share, is the same example I brought here, but I've supplied additional information. So what do we need now? For us, how do we get return on equity? Given this additional information.
25 divided by
return on equity should equal to
Net income.
net income divided by
equity. How much is equity? Net income is 25 million. How much is equity?
2.5.
75 million. From the balance sheet, we know equity is 75 million. So return on equity is net income. Additional information 125 million divided by 75 times 100. 33 and 1/3%. That's a third. Ingekuwa divisible. Suppose I wanted it to be divisible a whole number. Ningetumia ngapi hapa? 15. Suppose this is 15. Itakuwa ngapi? 15 divided by 75. That's what?
0.2.
20%.
Oh, 20%.
20.
Yes.
So suppose, let me work with 15, to avoid a lot of decimal points. So how much is the return on equity?
20.
Is it possible for us to find the growth rate? Look at the formula.
Yes.
This is the formula, the Marathon model. Book value per share, we don't have to repeat it, we know.
Yes.
Sio tayari mmepata? Mkiangalia hiyo swali, sio bado hiyo mnaijua, book value per share. Nyinyi ndio mmenipatia jibu.
Yes.
Book value per share ni ngapi?
30.
Hiyo ni 30. Return on equity ni ngapi?
20.
Growth rate?
12%.
12 mmepata namna gani growth rate?
Return on income on equity times retention ratio.
Yes. Growth rate you should capture using the Gordon's growth approximation equation, where growth rate is return on equity times retention ratio. So return on equity of found 20%. This is the payout. So retention should be 60%. You see, I've introduced the use of the Gordon's growth approximation model, where G is the return on equity times retention ratio. So return on equity, you have got it 20%. If payout is 40, the retention is 60. That means the growth rate should be 12%.
Yes.
The minimum required rate of return by investors, KS?
10.
It's given there. So is it possible to work out the value of a share using then the Marathon model? So what you're simply saying is that MPS is equal to book value per share R minus G over KS minus G. Book value per share is 30. Return on equity of found 20. Eh? Growth rate 12. Cost of equity?
10.
Haiwezekani. Hiyo haiwezekani. Growth rate is 12. So we can work with 15. Hiyo haiwezekani. So I need to go back to my illustration and change. Cost of equity use 15. Haiwezekani at 10. So that triggers change of the variable. It's not possible to work it out at 10. So can you work with 15? Eh? Cost of equity 15. So can you work with 15? 10, kwa hiyo swali badilisha. So MBS is 30, return on equity is 20 minus growth rate of 12, cost of equity 15 minus 12. Eh? There's no way, there's no way. I think one of the assumptions here is that the cost of equity must always be higher than return on equity. Eh? Otherwise, the model collapses. Eh? If the return on equity is less than cost of equity, or I mean, cost of equity is less than growth rate, or cost of equity is equal to the growth rate, that model collapses. Eh? The model collapses. So work with 15. What is the answer?
80.
80.
Yes.
Hiyo ni sawa. Finally, we have another model here inaitwa super profits model. This is another asset-based model valuing owner shares that involves the use of tangible and intangible assets in valuing shares. In this case, goodwill is taken as intangible fixed asset. Yeah, it applies both tangible, net tangible, and the intangible assets to value shares. Difference between expected profit and normal profit, which is a fair return on net tangible asset, is super profits. Expected and normal. I think here the assumption is that if for some time a company earns abnormal profits, where the expected earnings are much higher than the normal profit, then a firm will earn super profits. You can work out goodwill using this formula here. Annual super profit times number of years. I don't know whether you have applied this in accounting. Eh? There is accounting, goodwill, accounting for goodwill. Eh? I'm not sure whether you have interacted with this in your accounting studies. Sometimes you can work out goodwill by taking the super earnings times the number of years. If your super earnings are, say, 1 million, and you earned them over a period of 5 years, then you take the super earnings times the number of years should give you goodwill. Alternatively, we can take goodwill on the basis of discounting super earnings, assuming the super earnings are the same every year. Super earnings year 1, year 2, year 3, year 4, year 5 are the same. Then that super earnings are taken as annuity for discounting purposes. Annual super profits, assuming they're the same each year for a given number of years, then you can work out goodwill based on discounting the super earnings. So value per share is net tangible assets plus intangible. That's basically goodwill divided by the number of issued shares. Eh? Sasa hiyo mimi sijaweka illustration. And I think that brings to the end. Could you get you an illustration on that super earnings? That brings that issue of valuation to the end. Eh?
Mwalimu,
Yes.
kindly work out the book value. There are some people who did not get it.
The book value per share.
Yeah, the book, yes, that one.
Now, we had worked it out here. The formula is you take fixed assets plus current assets, which is 120, minus current liabilities. How much are the current liabilities?
20.
15.
15. Yes.
So 120 million minus 15 minus 20 minus 10. All assets less debenture capital, less preferential capital, less current liabilities. That you're left with equity. If you take 120 million minus 20 million minus 10 million minus 15, you're happy. Possibly 75,
Yes.
If you now 75 million divided by the number of shares, how many are the number of shares in issue here? The value of the share capital is 50 million divided by the par value of a share, which is 20. How many shares are in issue?
2.5.
2.5 million shares. 50 million divided by the par value of a share. The number of shares in issue are the 2.5 million shares. So 75 million divided by 2.5 million shares.
30.
Do you find shillings 30?
Yes.
Okay, I think that is fine. So I think that winds up this subject of valuation. We'll pick mergers and acquisitions when we meet next time. You already have handout notes on mergers and acquisitions.
Tweak.
So that the issues of valuation now, we will be applying this in the topic of mergers and acquisitions. Okay, so let me stop there. We shall meet
for the new class. We don't have the notes.
Mergers and acquisitions. Which notes?
No, these one we have read today.
The
notes have been uploaded in the module.
No, hakuna.
For CPA students, it's not yet.
Oh yeah, they are not there. It is because the topic is not there in your syllabus, but we'll apply it. I'll give you the notes. So for the CPA, yes, I'm aware. I didn't post that. You'll find them, But these ones you did them in session 3. Anyway, we are supposed to be applying them in session 5, isn't it, Joseph?
Yes.
Simulify section 3.
Yeah.
I don't mind. I'll give you the notes. I don't mind giving them to you. But my main interest is that now we'll be applying this in the topic of mergers and acquisitions, which we are moving on. See you, Dr.
Yes.
Yeah, so we'll connect issues of valuation to mergers and acquisition in our next class. For those doing BCom, we'll be moving to mergers and acquisitions, and we'll tie these issues of valuation to our discussion there. Just be going through the notes. So we shall meet. We shall meet next Tuesday.
Alim,
Yes.
how is the assignment submitted in the video?
Which one? Which one?
The group or
the group one?
Group.
Group one.
Yeah.
I don't know. Is it one individual to submit now or what? On behalf of the rest? I don't know. Can one submit on behalf of the rest? The team leader.
What do you think you can do?
Can the team leader submit on behalf of the others?
I think it would be wise if everyone submitted for themselves.
No. This group work, sitaki kila mtu submit. Mimi sitaki kazi mingi kutafuta ya kila mtu. Watu wote 100 nitaanza kutafuta hizo zote za ngapi sasa? Surely. No. Mimi sitaki kazi kama hiyo.
Group leaders can submit.
Let me ask, I will ask the IT guy whether there is that provision. But in the absence of that provision, then a team leader can submit on behalf of the rest. But I'll ask the IT guy whether there's a provision, then I'll let you know.
It will be sent through the email or
No.
WhatsApp.
No. All assignments and everything should be facilitated via Moodle. We are not required to use personal emails.
Okay.
Yeah, we're not required to use personal. Everything should be via Moodle. I'll ask the IT guy whether there's a provision for submission of group work. But if a team leader can submit on behalf of the others, the same way you are uploading a final exam. Somebody upload final exam for Moodle.
Yes.
Yeah. So what I need is a team leader to upload on behalf of the rest. Once I've got it, then I've got the assignment for the group. But I'm going to ask the IT people whether there's that kind of provision for submission of group work. But that means grouping you in Moodle, which is going to be a very hectic assignment.
Teacher, I believe the group leaders, if they submit, it's still okay because our names will be on the work. So
Yeah.
it's still okay.
So I suggest the group leaders, if you can submit on behalf of the rest, that is fine. Lakini sasa kuniambia kila mtu niende kuchukua kila mtu huko, surely itakuwa kazi mingi sana. Then again grouping you see the kind of hustle, itakuwa kazi ngumu sana. Okay, so we agree now that the group leaders can submit on behalf of the others.
Hello.
Yes.
It's my first class.
Yeah.
And I'm seeing people in groups and I'm not in any group.
There's a team lead, there's a, your class rep is McKenna. Please liaise with McKenna.
McKenna.
Yeah, she's here. Just liaise with McKenna.
Okay.
Maybe.
Hello, Molim.
Yeah, I think that's fine.
Hello.
Yes.
Okay.
Okay, I request maybe you can share to us the question on redeemable debentures. There was a question that was there. We never went through it.
I did. I've done an illustration in the. The notes, redeemable and irredeemable.
Debentures, the one you started with. There was a question of 20-something, 2012. I think it was
Oh.
CPA. Never shared.
Oh, EU convertible.
Yes.
Okay, fine. Okay, fine. I'll look for it. Yeah.
This last question with the last part we have just done.
Yes.
Kindly, I missed out on how we got 12% the growth.
Now, there's a formula for getting growth rate. A formula by Gordon.
Yes.
We have used the Gordon's growth approximation equation where growth rate is return on equity times the retention ratio.
Yes.
We have used that formula. And I've worked out return on equity by taking net income over equity. If you check in the question,
Yes.
I gave you net income.
Yes.
Net income. I don't know, I can't remember now. How much was it? 25?
15. We have changed to 15.
15.
15M.
And how much is equity?
75.
75.
Yeah.
Times 100. So return on equity was coming to how much?
20.
20%.
Yes.
Then this is retention ratio. In the question, what you have is payout. So 1 minus payout, 40%.
Yeah.
In the question, I've given you a payout ratio of 40%. So retention is 1 minus 40, which is 60%.
Yeah.
So if you take 60% times 20, it is 12%.
Yes.
Sidio?
Yes. Yeah.
I've seen.
So let's speak on mergers and acquisitions from next week.
Thank you, Mwalimu.
I have trashed to hospital. There's a friend of mine who has got mgeni na lazima niende kumchukulia mgeni kutoka hospitali. Amepata mtoto. Unaweza kupata mtoto hii wakati wa corona, hiyo ni baraka
Yes.
So I have to spare time and go kwenda kuchukua huyo mgeni hospitali. So let's continue mergers. I will finish with mergers on Tuesday. Yeah? Please try to go through the handout in advance because I will be moving very fast. I'll be moving very fast. The general areas of the topic, like what's a merger, what's an acquisition, why mergers and acquisition, theories that explains whether firm should be an east target, defense mechanisms against hostile acquisition. The stories, please get the stories. I think much of my effort is going to focus on the technical part of the topic, financial evaluation and valuation for purposes of mergers. The other stories are there in the handout. So let me stop at that. We shall meet. Let's connect next week on Tuesday. Yeah.